Welcome to the Deep Dive. Today we're tearing into the Q3 2025 results for Baker Hughes Company. That's ticker BKR. Their call was back on October 24th.
Yeah, and this one's a really interesting case study, actually, because you had really stellar financial result, a clear beat.
Right.
But the market reaction, not so positive. The stock actually traded down.
Which is always confusing. So, okay, great numbers, market caution. Let's unpack that right away. What were the headline figures that look so strong?
Well, adjusted earnings per share came in at 68 cents. That significantly beat the consensus estimates, which were more like 61 cents, maybe 62 cents.
Okay, solid beat on EPS.
Yeah.
And revenue.
Revenue was strong, too, $7.01 billion. Also comfortably above what analysts were expecting. So, check on the top and bottom line.
And operationally. I saw something about orders.
Oh, yeah, orders were huge. Total orders hit $8.21 billion in the quarter. That's up 23% compared to last year.
23%. Wow. Okay, so demand seems really strong.
Exactly. And they did this while managing costs pretty well, it seems. Adjusted EBITDA landed at $1.24 billion.
Which translates to what margin-wise?
That gave them a consolidated margin of 17.7%. And that's actually up 20 basis points year over year. So they're showing some good business discipline, cost mitigation working.
Okay, wait. Let me get this straight. Beat EPS, beat revenue, grew margins, booked a massive amount of orders. Why on earth did the stock sell off? Over 3% down, wasn't it?
It was, yeah.
So what spooked the market? Was it guidance or maybe one part of the business dragging things down?
You hit it right there. It's the classic tale of two businesses story playing out. To understand the reaction, you really have to split BKR into its two main segments. They're moving in kind of opposite directions right now.
Right. The Industrial and Energy Technology, IET, versus the Oilfield Services and Equipment, OSE. Let's break that down. Which one's the star?
Well, IET is definitely the growth engine, the long cycle, higher margin part they're betting the future on. And it had a great quarter. Revenue is up 15% year over year, hit about $3.4 billion.
Right. Okay. But the really big number for IET, the one that signals the future, is the backlog. It hit a new record, $32.1 billion.
$32 billion. That's huge visibility, isn't it?
It's incredible visibility.
Yeah.
And they added $4.1 billion just in orders this quarter, mostly from gas tech and power generation demand.
So that backlog, that $32 billion, it's basically guaranteed future revenue, right? You'd think that would change how people value the company.
It absolutely should. I mean, that kind of backlog supports a much higher multiple, more like an industrial tech company, maybe 15 times earnings. Not the typical 8 times multiple you see for cyclical oil field stuff.
Right. But the market seems stuck on that cyclical part.
It seems that way, yeah. Because when you look at the other segment, OFSE, well, the picture is quite different.
Okay, so what's happening in oilfield services and equipment?
That's where the caution comes in. OSE revenue is actually down 8% year over year, came in around $3.6 billion.
Down 8%. Ouch. Yeah. And management was pretty blunt about it. They're projecting a high single-digit decline in global upstream oil spending for the full year 2025.
So less drilling, less activity.
Exactly. And they even said they expect that kind of subdued activity might continue into 2026, blaming, oil market fundamentals, OPEC plus supply moves, the usual suspects.
Okay, so I see the divergence. Bullish on IET, cautious on office half. But is the IET growth really enough to offset a multi-year slowdown in the traditional oil field side? That seems like a big ask.
Well, the way management talked about on the call, it wasn't just about offsetting. It felt more like a fundamental shift. The tone was so different, right? Constructively bullish on IET, LNG, power, but very clearly cautious on the near-term oil cycle. And look at their actions. They're actively selling off some of the more cyclical assets to help fund big strategic moves like the Chart Industries acquisition. It signals they're really trying to pivot away from just riding the oil waves.
Okay, that makes sense. So let's zoom in on IET then. What specific wins are driving that $4.1 billion in orders and that massive backlog? You mentioned power generation.
Yeah, and that's where it gets really interesting, especially the link to AI and data centers.
The AI angle. Tell me more.
Okay, so first, LNG is still a huge piece. They locked down over $800 million in LNG equipment awards this quarter. That includes big stuff for Port Arthur Phase 2, Trains 3 and 4, and also for Rio Grande LNG Train 4. So long-term gas infrastructure is still very much in play.
Right. The structural demand for gas.
Exactly. But The power generation side is accelerating like crazy. They won a massive mobile power award over a gigawatt of their aeroderivative turbines.
A gigawatt. Where's that going?
It's for North American oil and gas operations, interestingly enough. Places where the power grid is getting strained, they need reliable on-site power.
Got it. And the data center connection.
That's the kicker. BKR has booked over $700 million in orders for power generation equipment just for data centers this year alone.
700 million just this year.
Yep.
And get this, they're now targeting $1.5 billion in data center orders. That was their original 3-year target. They expect to hit it way ahead of schedule.
Wow. So they're really capturing that demand surge. What tech are they using?
It's largely their no-volt turbines.
Oh.
They're efficient, modular gas turbines, perfect for the kind of distributed power that these new massive data centers need.
And management explicitly linked this to AI on the call.
Oh, absolutely. They made it very clear the generative AI build-out is creating this huge need for resilient energy infrastructure.
Yeah.
And Baker Hughes is right there providing the core equipment.
Okay. Any other notable wins in IET? Energy transition stuff?
Yeah, definitely. They highlighted a win in geothermal. They're designing and delivering equipment for 5 organic Rankine cycle power plants. It's for Fervo Energy's Cape Station project out in Utah.
Fervo, they're doing that enhanced geothermal, right?
That's them. This project is aiming for 300 megawatts. So it shows BKR isn't just LNG and gas turbines. They're playing across that broader energy spectrum within IET. Okay, so LNG, data center power, even geothermal. IET sounds like it's firing on all cylinders.
Yeah.
How did this translate into their actual guidance for the rest of the year and beyond? Did they raise it?
They did. Guidance went up pretty much across the board, reflecting that IET strength. For the full year 2025, they raised adjusted EBITDA guidance to greater than $4.7 billion.
Greater than $4.7 billion.
Okay. And for Q4 specifically, they guided adjusted EBITDA to $1.255 billion.
And for IE itself?
They bumped up the numbers there too. Full year IET revenue midpoint is now around $13.05 billion, and the EBITDA midpoint is about $2.4 billion.
Nice increases. Anything else on guidance?
Just a small note on execution. They said the hit from trade tariffs should now be at the low end of the $100 to $200 million range they previously expected. So slightly better cost management there too.
All right. This strong performance and guidance really underpinned that whole portfolio transformation story you mentioned, right?
Yeah.
Moving more towards industrial tech.
Exactly. And that transformation has 2 key parts: buying and selling. On the buying side, there's the huge deal to acquire Chart Industries.
Right, the $13.6 billion all-cash deal. How's that progressing?
They said it's on track, targeting a close around mid-2026. They're still aiming for those $325 million in cost synergies, but strategically, Chart is massive.
Why Chart specifically?
They're leaders in cryogenic tech. That's essential for LNG, obviously, but also critical for future stuff like hydrogen and carbon capture. Buying Chart basically cements BKR's shift away from just traditional oil field services.
So buying the future and selling the past, what are they divesting?
They're shedding some lower margin, more cyclical businesses. They mentioned progress on the surface pressure control joint venture with Cactus and also selling off their precision sensors and instrumentation business.
And that frees up cash.
Should do. They expect about $1.4 billion in gross cash proceeds from those sales. That cash helps fund the Chart deal and accelerates the pivot.
Makes sense. So this all leads towards their longer-term vision, right? What do they call it? Horizon 2?
Horizon 2, yeah. That's their set of big structural targets for the repositioned company.
And what are the key goals there?
The headline number is getting the total company adjusted EBITDA margin to 20% by 2028.
20% margin. That's a big jump from 17.7% now.
It is. And crucially, they said that 20% target is before factoring in any benefits from the Chart acquisition synergies.
Oh, interesting. So potentially even higher with Chart.
Potentially, yes. And the other big Horizon 2 target is locking in at least $40 billion in IET orders over the next 3 years.
$40 billion, just reinforcing that long cycle visibility again.
Exactly. It underscores how durable and high margin they expect that IET business to be.
Okay. This brings us perfectly to our next segment. Let's connect the dots here. This is not financial advice, everyone. But based on everything we've heard, the strong results, the huge backlog, but also the market's hesitation, what's an outrageous but plausible trade idea stemming from this call?
Well, the core thesis is pretty straightforward, really. The market seems to be looking in the rearview mirror. It's valuing Baker Hughes based on the near-term cyclical slump in the OFS segment.
Right.
And it's almost completely ignoring the massive long-term high-margin growth story unfolding in IET, especially with the Chart deal coming.
So the market's missing the transformation, basically. pricing it like an old oil field company instead of a new industrial tech powerhouse.
That's the arbitrage opportunity, isn't it? BKR should trade more like a specialized industrial player, think turbines, process tech, commanding a higher multiple.
Yeah.
But right now, it's weighed down by the lower multiple of the drilling services side.
So you're betting that re-rating happens faster than people think.
That's the bet, that the industrial tech reality asserts itself in the stock price sooner rather than later.
Okay, lay it on us. The outrageous but plausible trade is.
Go long BKR. The assumption is the chart deal closes smoothly, and IET keeps delivering on that growth in those margin targets, maybe even accelerates.
Long BKR.
Okay.
Okay. But what about the OFAC drag that the market's worried about?
That's the other side of the trade. To hedge that cyclical oil field weakness, you simultaneously short a pure-play OFAC competitor.
Someone without BKR's diversification.
Exactly. Pick a company that's much more exposed to that upstream spending cycle and lacks the LNG, power gen, and geothermal diversification that BKR now has.
Got it. So long BKR, short a pure play OFAC peer. It's basically a bet on that $32 billion IET backlog converting successfully and on the AI-powered demand story being real and sustainable.
And you're betting that within, say, the next 18 months, the market wakes up and starts valuing BKR based on that IET potential, giving it that higher industrial multiple.
Okay, a clear divergence play. So boiling it down for you, the listener, the key takeaway here is that Baker Hughes seems to be pulling off a major strategic pivot. They're actively prioritizing that high-margin, long-cycle IET growth, think LNG, AI-powered, geothermal, even as the traditional oil spending cycle looks weaker.
Yeah, this coal really felt like a signal flare. The age of gas, combined with this explosion in AI-driven power demand, is fundamentally changing where the capital is flowing in the energy sector. You really have to look past the quarter-to-quarter oil patch noise to see this bigger secular shift happening at BKR.
And let's leave you with this final provocative thought to chew on. Management is targeting that 20% total company EBITDA margin by 2028 before adding in any benefits from the chart deal. So the question is, what kind of extra boost could those chart synergies provide to that 2028 target? And maybe more importantly, how long will it take the market to start pricing in that potential upside before BKR officially updates that Horizon 2 goal?
That's the multi-billion-dollar question, isn't it? Something to think about. Thanks for joining us for this deep dive into Baker Hughes.
And remember, as always, this was analysis, not financial advice. Definitely go explore the materials yourself.